that we've done in partnership with More. So I know that you're in safe hands and you're going to be getting a lot of great information this afternoon. So I won't talk anymore, but I will introduce you to Bayan Lakdawala, who is the Director of More UAE, who will say a few words.
Good afternoon, everyone. Thank you so much for spending your afternoon with us. Veronica, thank you for the introduction, and to you and your team for organizing and hosting us again. A quick introduction on myself, our firm, and then we can get started with the topic of the day. As Veronica said, I'm Bayan Lakdawala. I am a director with More UAE. More UAE is a global public accounting firm. We are part of the More Global Network. Some of the services that we provide in the UAE are audit, tax obviously, corporate services and consultancies such as M&A evaluation and company formation. We've been operating in the UAE for 30 years and have a breadth of experience across all the business segments here. With regards to the corporate tax session, the reason why this one I think is a very crucial one, I think it is the first one that we have where the corporate tax law has been officially announced, and subsequently there have been numerous public clarification documents with specifics to free zone businesses and other sectors of concern. This is also the first session that we are conducting that is now part of the new corporate tax regime introduced by the UAE government. With me here today from our team is Mr. Gaurav Singhal, who will be taking this presentation forward. He is our head of corporate and international tax. Somewhere else in the crowd, I'm not able to locate, is Mr. Ankur Jain, who is our director of taxation as well. So feel free to reach out to us at the end of the session should you have any questions, tax related or even just business related in general. So at this time, I'd like to invite Gaurav to the stage and to orchestrate this presentation. Thank you.
Thanks. Gentlemen, ladies, Veronica mentioned that the first corporate tax session that we had was in the month of June last year. I'll let you in on a secret. There was no technical fault. The reason why we shifted the speed from here to here was basically to give you a feel of what kind of a radical change has happened in the context of taxation of free zones. Right? Okay, there was a technical fault. We wouldn't have to give you so much of inconvenience. But the point that I'm trying to make is that in June of 2022, when we discussed how free zone businesses are going to be taxed or will not be taxed. And all the distance that we have traveled from then to now, it's a radical change. It is actually a radical change. May not be a 180 degrees change, but certainly 90 degrees or more. The whole story started in January last year when it was announced by the UAE government that they will introduce a corporate tax. Somewhere around April, a public consultation document was released, and after that, we waited. We waited a long time, and finally, in December of 2022, we got what is called the official federal decree law on corporate taxes, basically taxation of corporations and businesses. And again, after that, we waited a whole lot of time because all of us were waiting basically to get the answer to the most fundamental question, that how are free zones going to be taxed? Because let's face it, the heart of UAE economy is in the free zones. That's where the soul resides. 1st of June 2023, the first day on which the corporate tax law went live. Right? That was the day on which the corporate tax law theoretically comes into force. The reason I'm saying theoretically is because practically, for a lot of you, the dates will actually be different. It depends upon what's the tax year that, or what's the financial year that you follow. So if you follow a different financial it begins from January. Then for you, the tax year also begins from January 24, because that's the first tax year that begins after June of 2023. But officially, 1st June 2023 was the date on which the corporate tax law went live, and that's also the date on which this rate got over and we received one cabinet decision and one managerial decision, both of which, when read together with the federal decree law, answer this core question, this million-dollar question, that how would free zones be taxed? From then till now, more has happened. We have received another public consultation paper from the Ministry of Finance, which deliberates upon these cabinet decisions after a ministerial decision, and that basically says more about what is the MOF's position about a lot of interpretations which are given in this cabinet decision and the ministerial decision. Today's discussion will be centered around all of that. So, as I mentioned, we will talk about which are those businesses which qualify for this elusive 0% corporate tax rate. So, that's where the learning for today's discussion, the takeaway for today's session begins. Not every free zone business qualifies for 0% corporate tax rate. No, nothing could be farther from truth. On the contrary, there are only some handful of activities, practically, which will enjoy a 0% corporate tax rate in respect of incomes earned from those activities. And basically what I'm trying to say is that if you look at the total sets of activities which are carried out by free zones by free zone businesses, in all the free zones put together, at least in the context of all these 700 clients that we are looking at from a corporate tax, international tax perspective, what we find is less than half of them qualify for the 0% corporate tax rate. Right? So therefore, a lot of times we are asked this question that my free zone told me that we will be eligible for next 20 years or next 50 years for no taxes. Where does that stand now? And the answer to that question is given in the federal decree law, which was released in December last year, because it says clearly that any provision or any text, I'm using both these terms, right? Any provision can be a provision in the law, but what if it is not a provision in the law, but a letter that you have got, anything of that sort? That's not a provision, right? But it's still covered in the expression any text. Any provision or any text that is contrary to this federal decree law stands abrogated. It stands superseded. Right? This is written in black and white in the federal decree law. So we will discuss which are the qualifying businesses, which incomes are qualifying incomes, which activities qualify and which do not. Those activities which do not qualify are called excluded activities. We'll have a couple of quick case studies and then we'll leave the floor open for Q&As. We'll talk about how to plan, what to expect. So we know about what do we mean by free zones. These are geographically earmarked area where there are promises, you can hold 100% of the capital in your businesses, and so on and so forth. So we are aware of what free zones are. So moving to the crux of the discussion, these are the timelines that we have already talked about, starting from the introduction of the idea of corporate taxes to the introduction of the law around taxation of free zones. First of all, let's understand the meaning of a very important term, which is called free zone person. This is a jargon because we don't use this expression in a day-to-day basis. Typically, we use the expression free zone businesses. Right? The tax law uses the expression free zone person. What is a free zone person? Not everybody who is in a free zone is a free zone person. Individuals are never free zone person. Even if you are staying here, even if you are working here, but if you are working in the capacity of individual, you are never a free zone person. A free zone person has to be a juridical person. Juridical means something which has been created out of juris, the law. It has to be an artificial person. A free zone corporation, a free zone company, a free zone LLC. These are the examples of a free zone person. Now there's a controversy around it, and just in case you are feeling exasperated that we have barely started and this guy has already started on controversy. There's a controversy. Would a branch also constitute a free zone person? And this, let me flesh it out further. For example, the public consultation document said that the companies and branches that are registered in a free zone They can be free zone person. But when we talk about branches registered in free zone, actually branches are registered elsewhere. They only have the license out here. Right? Typically a branch is a branch of a foreign company. What if you're talking about the branch of a mainland company? Mainland company having a branch in free zone, which is allowed, right? 2012 government. Would that also constitute a separate person? That is, would the mainland company be a separate taxable person from its own branch located in the free zone? And the answer to this question, like a lot of answers in life in general and in tax law in particular, is a yes and a no. If you see, the corporate tax law actually says this very clearly, that branches are to be regarded as an extension of their parent or head office and should not be considered as a separate judicial person. Which means, if you look at only this particular provision, it means a branch can never be a separate judicial person, therefore it can never be a free zone person. But interestingly, the corporate tax guide says that branch of a UAE mainland company or even a foreign judicial person registered in free zone is covered in the definition of a free zone person. So we already have a mismatch in the law that we have, and it is expected. It's not a criticism. Laws are supposed to evolve like this, with a lot of mismatches, with a lot of confusion, always constantly moving, striving for perfection, but never getting it. But well, the question which boils down to is that if you are a mainland company having a branch in GSO, will that branch separately qualify probably for some kind of a 0% corporate tax rate? And the answer, if you look at the totality of the things, if you take away all the contradictions, all the confusions, is interestingly yes. Which gives you, even before we start, which gives you a very clear idea of how you can leverage upon this to create some tax efficiencies, even for those businesses which are otherwise mainland businesses. I repeat, a mainland business is not otherwise supposed to be eligible for a 0% corporate tax rate. A mainland business is supposed to pay 9% corporate tax on its profits as adjusted by the corporate tax law. It's not the book profits. You start from book profits, but then you make some adjustments. So on that tax profit, a mainland business is supposed to pay 9% tax, corporate tax. But we already have in our law a legitimate solution that if some part of that business can be legitimately shifted to a free zone branch, you don't even have to set up a separate free zone company. If you just shift it to a free zone branch, and if that free zone branch qualifies all those conditions which we will talk about today, there you have it, a legitimate opportunity for tax efficiency. Okay, with this, let's quickly look at what are the tax rates which apply to a free zone person. Because I told you, a mainland entity, it is subjected to a tax rate of 9% after the first 375,000 dirham of income. The first 375,000 dirham income, a mainland company doesn't pay tax. Now, let's look at the same very question from a free zone perspective. If a free zone entity does not qualify for 0% corporate tax rate, assume, right? I wish all of you do. But if your business does not qualify for the 0% corporate tax rate, then you should also get the same very initial exemption of 375,000, right? Right, yeah? No, you don't. These are two separate tables. For free zone persons, either you are subject to tax at 0% or you are subject to tax at 9%. There is no initial 375,000 dirham that you get for free, that you get taxed. This entire concept of first 375,000 dirham worth of income being tax free is applicable only for mainland businesses. If you are a free zone business, then either you enjoy no taxes, or if you are taxable, then every single benefit is taxable. Even the first 375,000 dirham, the tax rate remains 9%. For all of you who are as much of a tax geek as I and my team are, if you have heard of these words, OECD, base erosion profit shifting, Pillar 2 norms, and so on and so forth, you will probably find that in a few years, in some cases, this rate will go from 9% to 15%. But that's for future, that's for another session. In that session, probably we will turn around the screen another 9%. Right? I've been talking about 0% corporate tax rate being eligible for free zone person. No, qualifying free zone person. Right? So the question is, what is a qualifying free zone person? Well, free zone person we have already discussed. Free zone person is any business which is registered in free zone. It could be an LLC, it could be a branch. branch. Right? But then what is a qualifying free zone person? What is this additional condition of qualifying? A qualified free zone person is one which first of all is not a shell entity. You have not just set up a shop here for the sake of it, but actually no real operations or no core operations are happening here. No, it should have substance here. It should not be a shell entity. So the first condition is it should have adequate substance. Now, I'll pause here and pivot it a little bit. For those of you who have been subjected to economic substance regulations, and if you have not been, for the love of God, please to get this kind of an analysis done, that are you or are you not covered by economic substance regulations, because we have seen some clients that have started receiving notices as to why did you not do your economic substance filings. And you're supposed to do 2 filings every year. One is called a notification, another is called a report, but that is for another day. But those of you who have been subjected to economic substance regulations, you might have come to a conclusion that you are not required to undertake those filings. Why? Because ESR filings are required to be undertaken only if you are carrying out of any 9 kinds of activities which are called relevant activities. If you are doing any activity other than those 9 activities, then this substance condition never haunted you in past, because that condition was there only in the economic substance regulations. Now, in order to qualify as a qualifying free zone person under the corporate tax law, you'll be required to meet the substance condition even if you're not covered in those 9 activities. I repeat, forget about those 9 relevant activities in the economic substance regulation. If you're doing any business in free zone and if you aspire to have the benefit of 0% corporate tax rate, then the substance conditions apply. Right? You are required to have substance here. What do we mean by substance? Is something that we will discuss in the next slide. What are the other conditions in order to be a qualified free zone person? You should be earning qualifying income. What incomes are qualifying incomes? There is no one single answer. There are 3 different, or actually 4 different answers to this question. Depends upon what's the nature of your business and depends upon what kind of clientele you have, what kind of customers you have. Are your customers also located in free zones? Or your customers are located in mainland? Or are your customers located outside of the UAE? Are you in real estate business? You know, several questions will, in a combined reading answer, will answer whether or not you are earning qualified income. We will look at that today itself. Third condition. You should not have yourself elected that I want to give up the benefit of the 0% corporate tax. Now you'll ask me, oh, come on, you are pretending to be an expert over here. Why would anybody in his right mind, himself or herself, elect that I don't want this 0% corporate tax rate? 0% corporate tax is awesome. 0% tax or no tax is what brought us here. Why would we give it up? I see so many. Well, the answer could be, for instance, what if presently you are in a setup phase, presently you are in a startup phase, presently you are bootstrapped, presently therefore you are incurring losses. If you are incurring losses, then the position will be that if your income is not taxable, then even your losses will be ignored. You cannot carry forward those losses to future years. You cannot adjust the losses of your one entity against the profits of your another group entity, which by the way is a very interesting phenomenon in the UAE corporate tax law. I repeat, if in the same group there are 2 entities, company A and company B is incurring losses, company B is earning profits. You can, subject to certain conditions which are always there in life, offset the losses of company A against the profits of company B. If company A is taxable. If it is a free zone, qualified free zone entity which says that I enjoy 0% corporate tax rate, then the FTA will say that look, if your income is not taxable, then your loss will also be good. I will not allow you to offset it against the profits of company B. And then you will have a reason to say that, okay then, till the time I'm incurring losses, I elect to give up. I'm such a such a big-hearted person. I give up the benefit of 0% corporate tax rate only for the US corporate tax rate losses. Once you start making profits, then you opt for it. But for those initial years when you are incurring losses, you will elect out of this 0% corporate tax rate. Because in those years, your losses will be eligible to be set off against the profits of your group entity. Again, second example of how you have some tax efficiencies that you can achieve if you attend Moore's corporate tax sessions. If you attend knowledge. Third country. Just because your income will not be effectively taxed does not mean that you can ignore something called transfer pricing regulations. What are transfer pricing regulations? At their very soul, these are regulations which demand from you that even in any related party transaction, you have to act at those terms at which you have acted with unrelated party. With unrelated parties, you keep them at an arm's length, which is the reason why transfer pricing regulations operate on the principle of arm's length price. So just because your free zone entity is a group company of your customer or your supplier does not mean that in your transactions with your customer or supplier, you start ignoring markup or you start charging less or more markup just to benefit that other entity. No. Which is the reason why in all your transactions with your related parties and connected persons can be individuals, your shareholders, your directors, you are obligated to operate at arm's length price, which is a subject matter of a huge discussion, because practical applicability of transfer pricing regulation is something which will require much more intensive analysis. Probably this can be also the discussion subject matter for another discussion another day. And lastly, there are several other conditions which could be prescribed. Let me give you an example of one condition which will probably shake us. So far, we have been accustomed to the idea that sometimes we are not required to get ourselves audited, or sometimes the audit occurs at a consolidated level. Rather than one single entity getting its accounts audited, the audit occurs at a parent entity level, at a group level, right? Not anymore. If you are a free zone business, if you are a free zone person, and you want to enjoy this 0% corporate tax rate status, you are required to prepare stand-alone financial statements. You are required to get them audited separately every year after year. So again, this is something which is also a significant change from what we have generally been accustomed to. A few more such other conditions which we will talk about, when we are talking about specific businesses, because specific businesses, specific activities, specific incomes will have their own sets of conditions that we will talk about them. But what we just now discussed are the conditions which apply to all free zone businesses if they want to enjoy the 0% corporate tax, if they want to be qualifying free zone persons. Moving on. The first condition, adequate substance. What do we mean by adequate substance? It's highly subjective, but fundamentally speaking, a free zone person can be said to have adequate substance firstly and foremostly if it undertakes its entire core income generating activity. That activity for which it has been formed, that activity from which it derives its core income. All of that activity has to be carried out from within the free zone. That means if you have another office located in the mainland, some of the employees are located in the mainland, will that do? Not really. If you're a part of a group, right, a corporate group having 4 entities, some of them in mainland, some of them in free zone, can some of the employees of the free zone entities sit in the mainland offices and work? Not really. They're carrying out the 4 income generating activities? Not really. Would the senior most strategic level people, I repeat, the senior most strategic level management, decision making, CXO lead people, those guys, can they operate outside of the UAE? Because you're a part of a Middle East group, or you're a part of a global group where these people are not located in UAE. They come here once in a while, but predominantly they keep traveling. They are global citizens. Right now they are in Singapore, and for next 4 months they will be in Singapore taking strategic decisions for your free zone business. Not sure, because that is probably going to be a core income generating activity. Decisions relating to core income generating activity are themselves core income generating activity, and if all those decisions are predominantly being taken outside the free zone, mainland or any other country, then you do not meet the first condition of adequate substance. As it is, you can probably feel a lot of these things are going to ruffle the feather, disturb the status quo that we have been acquainted with. You should have some adequate number of assets, value of assets. Now, what is adequate? Depends upon what kind of business you are in. If you are a consulting business, then probably your laptops are adequate. Right? If you are into manufacturing, that means all the property, plant, equipment which are appearing in your financial statements, they need to be here. So, what is the type of assets, what's the number of assets, what the value of assets will entirely depend upon what kind of business you are in. Similarly, you should have adequate number of qualified employees. I'll give an example. Suppose yours is a business which is located in DSO and it's minting money literally by earning millions of dollars worth of revenue every year. And when we ask that how many employees do you have over here, the answer that we get is 2 employees. One who takes all the call, other who serves beverages to the first person taking all the calls. And then our question is, hold on. And how are you making all that money? Because you must be doing some activity, right? Where are all those employees located? And the answer is, no, they're actually located in India, they're located in China, but we have to set up a company over here. Right? We are just basically printing invoices for you. And by the way, today, we don't need to print invoices. We just email it, right? Then, would you be able to justify to the FTA that you are earning millions of dollars worth of revenues with only 2 employees, one of whom is basically an office boy, giving water to those people who visit once in a while? You won't be able to defend it. Unless you are in some extreme business where this one single person who's calling for all that water from this poor office boy is the brainchild and he's actually doing the entire business from here somehow. That has to be some intellectual property different business. But other than that, what do we mean by qualified? Depends upon the qualifications which are required for that particular role. But just having some X number of people, no experience, no qualification, basically just starting it up is not going to serve the purpose. In fact, even in the ESR audits, economic substance regulations audits, which are already underway or already closed by the FTA last year, what we saw was that they have actually asked how many people are working, what's the size of your office, shows the area of your office, is your office big enough to seat all those people that you claim are working? And then all those people send us their CVs. We want to look at what are their qualifications and experiences to be able to justify that they are playing that very role which you are saying that they are playing. Right? So all of these questions are already being asked by the FTA, but in a different law. Now these questions will be asked in the corporate. Finally, in order to earn, you should also spend a bit. Right? So, do you have adequate amount of operating expenditure in this free zone entity or not? Operating expenditure does not include cross charge by group entities. So you can't simply say that my group entity is spending all that money, I'm just reimbursing a part of it, and that is operating expenditure. No, that's an expenditure which has to be again incurred in the free zone. That brings us to the question now. That fine, I am a free zone person. I'm a qualifying free zone person to the extent that I have adequate substance. What was the next condition in order to be a qualifying free zone person? You should be earning qualifying income. And I told you qualifying income has multiple meanings. Because it depends upon what kind of customers you have. If your customers or clients are located in free zone, then the meaning of qualifying income will be different. If your customers or clients are located outside the free zone, this can mean mainland, this can also mean outside the UAE. Both of them are covered in this free zone to non-free zone transaction. Then the meaning will be vastly different. The meaning of qualifying income will be vastly different. If your business is that of real estate, renting out of commercial properties, then a different set of rules will apply. And lastly, there is some residual category which is also allowed that, okay, if you have earned some other incidental income, small incomes and so on and so forth, then fine, we will not subject you to 9% tax only because you have earned some small amount of income from here, there and there. Right? So small leeway, small safe harbor is there. We talk about these. I'll focus on first, second and last because if any of you are actually renting out commercial properties, right? If you are landlords of commercial properties, 15, 20, 50, 100, I'll charge you. Right? Okay, I'll not charge you, I'll probably just settle it over a cup of coffee, right? But I'll still like to talk to you. But I think the bigger focus of this group, I'm guessing, would be on those businesses which you are doing with your clients which are located in free zones or free zones area. Let's talk about each of these categories, beginning with the first category. I repeat, right? Just to get the context right, you are a free zone business and your clients are also located in a free zone, any free zone, DSO, JAPSA, DFCC, any of them. I'm fine with it. As long as we are dealing with those clients that are located in free zones, a separate set of rules will apply. I'm not saying that you cannot have non-free zone clients, you can have it. What I'm saying is, to the extent your clients and customers are also free zone persons, the rules that will apply are the ones that we are discussing now. Because those rules are awesome rules. Those rules are basically that any business that you do with other free zone persons, with your clients or customers that are also free zone persons, all of that, in general, mostly 95% of it is going to qualify for 0% corporate tax rate, right? I see a few smiles. For the first time, Gaurav, you have opened your mouth and said something nice. Because otherwise, all this time, you were saying things which were depressing us. I'm not such a bad person. So, if you are a free zone business and your client is also a free zone person located in any free zone, then subject to a few, very few conditions, which are very reasonable conditions, your income from this activity will enjoy a 0% corporate tax. That income can be from trading, that income can be from services, that income can be from group-related services, that income can be from financing. So think of all those activities, right? Social media management, everything under the sun that comes to your mind, most of them is going to qualify. What will not? What will not? If some smart person thinks that, look, boss, all my clients are located in mainland. All my clients are located in mainland, and therefore I do not get this benefit. So what do? I set up another free zone company and route all my sales through that free zone company. I repeat, you already have a free zone company. Let's call it company A. But your clients are not located in free zone, so you decide that what the hell, let me set up another free zone company. Let's call it A1. Now, rather than A selling to mainland companies, A will always sell to A1 at market price. And after that, A1 will sell to mainland customers at no profit or nearly no profit. That means all the profit is booked in company A, and because its client is a free zone person, A1, your own group company, therefore it will enjoy a 0% corporate tax rate. Do you think lawmakers are going to be that blind to it? Obviously. Which is the reason why it's a very logical condition. That your customer should be a beneficiary, recipient of those goods and services which you are selling them. I'm not saying that he should consume it all. No, he has every right. Your customer has every right to sell the services onwards, but on his own terms, at his own volition. It should not be the case that everything you will sell to one free zone person will always then meet a fate which will be decided by you in the first place. That should not be the case. Which is logical, right? Otherwise, everybody will easily bypass the first condition that we are only, this condition being dealing only with free zone to free zone customers. We'll be easily able to bypass. What is a beneficial recipient is, or what is a beneficial, who's a beneficial owner, who's a beneficial recipient, is sometimes litigated in some other jurisdictions. But in my experience of last 23 years, what I've seen is, more often than not, this litigation arises in those areas where there are group company transactions, where you are trying to beat this. If you have independent third-party clients, then you will not face the challenge of whether or not your client is a beneficial recipient. Is this clear? The only condition is there are some activities which are still excluded. A handful of activities which are still excluded from the 0% corporate tax rate, even if your client and customers are free zone persons. Now let's look at those activities which are excluded. These activities are called predictably excluded activities, or EA. Which activities are excluded activities? Any activity in which your client or customer is an individual, a natural person. I'll give you an example. As you are running a restaurant in a field. Free zones have restaurants. After all, we need foods to fill our tummies and brownies and occasional drink. So we have restaurants running in free zones, but their customers are all individuals. These restaurants will not be eligible for 0% corporate tax rate simply because any transactions with natural persons are excluded activities. There are some exceptions, we will talk about it, but those exceptions are very, very specific. They deal with regulated fund management, investment management, or wealth management activity. If you are interested in it, that means you're a big guy, we'll talk about it. But other sets of activities, banking activity, insurance activity, and finance and leasing activities. Again, these activities, if they are carried out from within the free zone, even if your clients and customers are also free zone businesses, still, you are big guys, banking, insurance, finance, leasing. You are literally the one who are making money. When I'm saying making, you are manufacturing, right? Then, let's pay taxes. If you are leveraging upon intellectual property, let me explain. You are a free zone company, you are a free zone LLC, you are a free zone establishment, and your core business is that you created an intellectual product, such as a patent, right? Such as an invention, and now you give that invention to other people who use that invention to manufacture goods and sell them, and in turn they give you royalty. So your entire income is royalty, right? Then your entire business is leveraging upon intellectual property, and you do not enjoy this 0% corporate tax rate benefit. Mind you, if you have certain intellectual properties in your business which you are using for your own business, you are not giving it out to others, you are not earning royalty, you are using your intellectual property for your business. Such as you have a patent and you use that patent to manufacture goods on your own, or you own copyrights in a software, right? You own copyrights in a software, you coded a software, an awesome software which helps us do algorithmic trading, or an awesome software which helps me predict the prices of a particular cryptocurrency. Then that's a software which you are not hiring out to other people. You're not earning royalty from it, you are using it for your own business. Good thing, do it. Then you are not covered. Then you are not an excluded activity. Then you are eligible for 0% corporate tax rate. The thing is, you are an excluded activity when you are earning passive income by renting out your intellectual property. That's it. If your entire income is rentals from immovable property, then we will see that how in some cases your income will enjoy 0% corporate tax rate, and those are very, very reasonable cases. But otherwise, you will be covered under excluded activity. Right? So if you are landlord, big landlord, right, and you are earning a lot of rental income, then that is also in a sense of speaking passive income. And again, this passive income will a lot of times not be eligible for 0% corporate tax rate. There are times when you will be eligible for it, and we will talk about it 5 slides down. Lastly, any activity which is ancillary to the other activities we have just not talked about. Ancillary means, this activity feeds into the original activity. Ancillary to these other categories, then the income from that ancillary activity will also not be eligible for 0% corporate tax. By the way, I want to give you a bit of good news. All those people who are taking these slides, I don't know what you want to know, but we will share these slides with you. So you can just relax. I always feel nervous that even if I have a 256 gigabyte of memory space in my phone, I always feel it's running out. And I don't know whether it happens to you or not, but if I made a big video, right, then I feel that when the video is completed and stored, I feel my phone has got heavier. You do that? No, I was joking actually, right? But my point is, don't bother yourself with all this, you will get this PDF file. So far we were dealing with which kind of client? A client which is also a free zone business. Now we will deal with that client which is not a free zone business. That client which is located in either mainland UAE or for that matter outside the UAE. There, the set of activities which are eligible for 0% corporate tax rate, that is a very narrow set of activities. Right? So far what did we see? In a free zone to free zone business scenario, Every activity under the sun except these excluded activities is eligible for 0% corporate tax rate. Right? So this is a negative list. Apart from this list, everything enjoys 0% corporate tax rate. Now what we see is, where your client is a non-free zone person, then none of the activities qualify for 0% corporate tax rate except only some. And which are those some activities that we have to talk about? These activities are called qualifying activities. We will talk about what these qualifying activities are. These activities are qualifying activities. Let's look at each of them one by one. Firstly, if you're carrying out any kind of manufacturing or processing in a free zone. What is manufacturing? Manufacturing is defined as any process in which the input and the output are two vastly different products as recognized in the market. Okay. Sometimes a product does not undergo a significant change. It undergoes only a slight reduction. And even that is covered under processing. So manufacturing and processing, both activities, if carried out in a free zone and then you sell it to even a non-free zone person, will enjoy a 0% corporate tax rate. But interestingly, once the public consultation document for free zones was released last month, then this definition has also undergone a slight of change because it is to be read with the next activity of distribution. So let's first understand what is distribution. Distribution is any activity in which you buy good and you sell it. So first of all, if you're selling for commission, that's not distribution. Because when you're selling for commission, you never acquire the legal property, legal title in the goods. Distribution is an activity in which you are supposed to first acquire the legal title and then transfer. You first buy goods and then you sell them. Mind you, I am consciously using the words legal title. I am not using the words possession. I am not insisting that you should first get the possession in goods and then you should transfer possession in goods. Even if possession never comes to you, it's okay. I am not a possessive guy. But I'm married, so I'm not trying to sell. What I'm saying here is, for example, if suppose, look at both the scenarios. The first easy scenario in which I have a warehouse in Japsa. I import some goods from outside the UAE here. I've got those goods here in my Japsa warehouse, and then I sell to my mainland customer. Why mainland? Because we are talking about qualified activities which are relevant for non-free zone clients. Here, I have not just acquired the legal title, I have also acquired the possession of goods, right? Is this a distribution business? Absolutely. In the second scenario, in which you don't get the possession, is a classical scenario of a third port shipment, or what we call the bill to ship to activity. I have a small office out here, and from that office, I place orders from China, Indonesia, Vietnam. But even before goods reach me, I already have buyers located in another part of the world, say Africa. So I inform my supplier that I am buying the goods, but don't send them to me. Instead, send them directly to this address where I am telling you about, which is located in Africa. This is called a third port shipment model. These goods never enter UAE. It's not just that you don't get the position, UAE never gets the position, and still it's okay. Still okay, even that will be eligible for the definition of qualifying activity, subject to some more additional conditions which are extremely important and we'll talk about it. But let me go a step back. If you are a manufacturer, after having manufactured your goods, what do you do with those goods? You distribute them. Otherwise, you are not going to keep those goods with yourself, right? What's the point? You distribute. Therefore, interestingly, those conditions which are applicable to distribution business, a business which is only in distribution, never into manufacturing, those conditions also haunt a manufacturing business. Because a manufacturing business will earn profits from two activities, manufacturing activity and then distribution activity. You will have to divide how, we'll come and tell you about that, but essentially you have to divide your total profits into these two parts, profits which are attributable to manufacturing activity, profits that are attributable to distribution activity. which is attributable to the distribution activity, that part of the profit has to also meet the conditions which are applicable to a distribution business, and those conditions are some really serious conditions, and we will talk about them in 30 minutes. Which are the other qualifying activities? Logistics, which is big in this out, right? If you are into logistics, if you now move goods from one person to another, one place to another, and this time you do not get the legal title at all, then you are a logistics service provider. For instance, the 3PL and all those services are covered in qualifying activities. Therefore, if you are moving goods from free zone to mainland or from any place outside the UAE, your income will be eligible for 0% corporate tax rate, subject to other conditions, in spite of the fact that your clients are not free zone businesses. If you are only a SPV, a special purpose vehicle, the purpose of which is only to hold shares and sit pretty over them, right? Sometimes we create special purpose vehicles only so that they can act as a holding company. Then the income of this special purpose vehicle located in free zone will enjoy 0% corporate tax rate. But let's wait for a second. What kind of income are we talking about? The income which arises from holding of shares is either dividend or capital gain. All the dividend which is earned from a company which is formed, registered here in the UAE, where mainland or UAE, mainland or free zone, is anyway exempt. Right? I repeat, dividend income from a UAE company to anybody, you in your individual capacity, your mainland company or free zone company, to anybody is anyway exempt. So no big deal. Dividend income from a foreign company, now that is exempt subject to some intricate conditions called participation exemption if you are a mainland shareholder, or if you are if you are a mainland shareholder. But for a free zone company, that intricate conditions of participation exemption are not applicable. For example, a mainland shareholder will enjoy exemption from tax in respect of a dividend earned from a foreign company if and only if it has at least 95% or more shareholding in that foreign company. This 95% condition is therefore mainland shareholders. If you are a free zone shareholder, you own only 40% shares in a foreign company, participation condition not met, still it's a qualifying activity. That means 0% tax. Another very important role, and this is a role which UAE really wants, right? It really works hard to achieve for all the businesses that are located here. And that role is that of a headquarter function or a treasury and finance function for group companies. Look at Singapore, look at Hong Kong, right? These are jurisdictions which have, with all due respect, no natural resources per se. And yet, when it comes to their financial prowess, they are forced to reckon with, right? If you look at the globe, their location on the globe is a pinpoint. And yet, when you look at the economic flows, the business flows, the money flows, Singapore and Hong Kong, they enjoy a special position. In spite of all the unrest which happened on account of China, Hong Kong still enjoys a very important key position in Asian markets and also in global markets. Naturally, anybody would want to strive to achieve that very position. UAE does too, which is the reason why if there is a multinational group of which there is one company located in UAE which tries to carry out headquarter function. First of all, let me explain. Headquarter does not mean that this UAE company should be sitting pretty at the top of the entire holding structure. No, I'm not saying that it should be the ultimate shareholder in the entire chain of, in the entire corporate holding structure. I'm not saying this. A headquarter entity is basically an entity which may be located anywhere in the capital structure. Its function is to be responsible for the success or failure of the group and to provide services of strategic decision making for the group. That is a headquarter company. You may not necessarily be the company which is sitting at the top of the entire complex Christmas tree of your corporate holding structure. Not required. Similarly, any company which is rendering treasury services or finance services to its other related parties in the same group, not to third parties. because that would become banking, and banking is excluded activity, right? If you are giving these services to your related parties, that means you are probably the cash pool of your group. Now that entity will also enjoy 0% corporate tax in respect of its income. Which kind of income streams would they be? More often than not, from treasury and finance services, similarly from headquarters services, you either earn managerial services income, consultancy income, group consultancy income, or good old interest and finance charges, corporate guarantee fees, corporate service fees, so on and so forth. For all of that, the tax rate will be 0. These are some very specific kinds of businesses: reinsurance, fund management, wealth and investment management. If you are interested in them, we'll probably talk about them in separate discussion. Why? Because all of these are those businesses which will enjoy a 0% corporate tax rate if and only if they are regulated businesses, which will bring us to obviously the next question: what kind of regulations are we talking about? And those regulations differ from the nature of business, one business to another. They also differ from where are you located out of? Are you located out of ADGM? Are you located in the IFC? And so on and so forth, right? So those are very specific kinds of businesses. But if you are a regulated investment advisor, if you are a regulated wealth advisor, if you are a regulated fund manager, or even an advisor to the fund manager, interesting, even an advisor appointed by the fund manager, all of them will also enjoy a 0% corporate tax rate. Shipping. It goes without saying that when it comes to UAE, shipping is very dear to its heart. You know, if we go back into our history, what we find is that is one of the sectors which significantly contributed to the change that we see today in UAE. Any person which is engaged in the activity of ownership, management and operation of ships is also eligible for its income from such activity to enjoy a 0% corporate tax rate. Now, here's something interesting which I want to highlight here. Even if you do not actually own a ship, your company does not own a ship, but it has taken a ship on a wet charter basis or on a dry lease basis, right? Then too, any income that you earn from this wet lease or a dry lease will be eligible for this 0% corporate tax rate. If you are only a shipping commission agent, then you are not covered in this bill. Lastly, similar thing is also available in the context of aircrafts. Pretty much the entire world is jealous of Ireland. If you look at the total number of aeroplanes which are today flying in the sky, you will find that a majority of them are owned by a company located in Ireland. There is one statistic which says if you add up the total surface area required to store all these aeroplanes in hangars which are registered in Ireland, Ireland will fall short of the land space. Ireland has a very interesting law, which is the reason why it is a hub of finance leasing for aviation sector. Everybody wants to be that. Everybody wants to be, right? If you look at the tax laws of China, they also try to recreate that model. A year back, India also changed its tax law in the context of its GIFT City International Financial Services Center, where it covered the same very operations as a tax holiday one under the GIFT City regulations. What EU tried to do was EU tried to discourage Ireland by imposing upon it at an EU level, mind you. Penalties running into millions of euros, nothing stopped it. So now everybody wants to be in that race. We are behind. We also want to be in that race, and therefore even this activity is covered in the list of qualifying activities. So if you are earning any income from any of these activities, then even if your client is not a free zone person, even if your client is a mainland entity or a foreign entity, you will enjoy a 0% corporate tax rate from commercial properties. If you are a free zone person that owns a commercial property which is located in a free zone and you are renting it out to another free zone person, three conditions, I repeat, you are a free zone person, your property is a commercial property located in free zone, not a residential property, right? Even a hotel is effectively a residential property because it's used for residence. So So even that is not allowed, right? A commercial property located in free zone and you are renting it out to another free zone business. If all these conditions are fulfilled, then your rental income will also enjoy a 0% corporate tax rate benefit. For example, you are that green box, the free zone person. This blue building is your property in the free zone. It's a commercial property. Suppose it's a warehouse. Then if you let it out to an LLC, by LLC I mean a mainland company, right? Here by LLC I mean a mainland company. Or to a foreign company. Then the third condition is not met. The lessee is not a free zone person. Therefore, will it enjoy the 0% corporate tax rate benefit? It won't. But if you rent it out, the same way warehouse which is located in a free zone, if you rent it out to another free zone person, then will it enjoy the 0% corporate tax rate benefit? Absolutely. And similarly, for offices, similarly for convention center, but if it's a guest house, again a guest house is a residential accommodation. Whether you rent it out to another free zone person or to a non-free zone person, because it is a residential property, in none of the two scenarios will it be eligible for 0% corporate tax rate benefit. If you have booked, this is a highly theoretical example. If suppose you are a free zone company, you have called for a delegation, and in that delegation a lot of your clients and customers have flown from different parts of the world, you have booked a luncheon for all of them at Radisson Bread, which is also a commercial property located in free zone. Mind you, I'm saying luncheon, you are not booking for their rooms because that would mean residential. Right? But luncheon, that's not residential. And therefore, income from that technically, only technically, not practically, will enjoy this 0% rate benefit. Why I'm saying technically and not practically is because for a hotel, bulk of its income will come from room rentals. This kind of income will be far inferior. Right? Bulk of its income will come from room rental. Therefore, that income will never qualify for 0% rate benefit, and therefore it will always get disqualified. Why would it always get disqualified? And that is because of this last clause called de minimis clause. This de minimis clause basically tries to achieve two objectives. What are those two objectives? First, if you are predominantly earning that income which enjoys a 0% rate, then just because you happen to earn a small bit of non-qualifying, that does not mean that will disqualify you fully. No. I'll give you an example. Suppose you are a manufacturer, suppose you are a distributor, you meet all the conditions, but then you have some bit of scrap and you sold that. And that scrap sale, for whatever reason, did not meet the tests which we are yet to discuss. Then that means that just because you earn a little bit of amount from scrap sales, your entire income will lose the benefit of 0% rate? No. It should not. It will be heartbreaking. The first objective is therefore that small amount of income will not throw a spanner into your plans of no taxes. Right? That's the first objective of this de minimis clause. De minimis means at least. The other objective works the other way, which is that if a bulk of your income is non-qualified, then you cannot say that, okay, fine, then whatever that small amount of income which is qualifying, at least for that, give me 0% rate. No. If you get disqualified, then you disqualified in respect of all your income. Then, even if some of your income, 20-25% of the income, 20-25 is sizable by the way, right? Even if your 20-25% income is otherwise qualified, you will not get the benefit of 0% corporate tax rate, even in respect of that otherwise qualifying. Can you still achieve it through a bit of legitimate structuring? The answer is yes. But plain vanilla, de minimis clause blocks. De minimis clause says, look at two numbers and decide whichever is lower. Which are these two numbers? First number is an absolute number, 5 million dirham. Second number is 5% of your total revenue. Look at your business, what is your revenue? Look at that. 5% of your total revenue or 5 million dirham, whichever is less. Up to that, if you have earned any non-qualifying revenue, no worries, fine, we will not tax it. No worries, because of this non-qualifying revenue, we will not deprive you of your 0% corporate tax rate status. Fine. So, basically, to give you an example, suppose you are a manufacturer or suppose you are a distributor. 97% of your business is with other free zone persons, but 3% of your business is with one individual. One individual. Now, transactions with individuals are excluded activities. They are otherwise disqualified. So that means the moment you have some disqualified activity, does it mean that you will get disqualified from the 0% corporate tax rate? It is no risk. Relax. You don't have to worry about it. So long as that 3% revenue is less than 5 million dirham, all is cool. Your entire income, including that income from that individual sales, right, will enjoy 0% corporate tax rate. But if that non-qualifying income or the sum total of all your non-qualifying incomes, sum total, exceeds either of these two sums, either 5 million or 5%, 5% of the total, then you are in a soup. You lose the advantage of 0% corporate tax rate. You lose it for this year. You lose it for next year, and next year, and next year, and the one after that. I repeat, if you lose because of any lapse, you are not foregoing, you are not electing out of it. You committed a default and you lose because of the default. Then you don't lose it just for 1 year. One default costs you 5 years of corporate tax. Because one lapse will mean that you will lose the 0% rate benefit for a total of 5 years, including this year. So don't think that, come on, 2024 is just next year. Right now, I don't have to bother about how corporate tax affects me. Because what's the worst that's going to happen? I have to pay 9% tax on my income from 2024, right? No worries. I'll fix it in 2005, Baba. And from then, I will live happily thereafter. I will not pay any tax in 2025 or 6 and thereafter. No, sir. If you make a mistake now, then you will pay tax in 2024. And then, after learning from your mistake, you fix that mistake in 2024 itself. And yet, in 2025, 6, 7, 8, you will continue paying taxes because one default costs you 5 years in total. Is this clear? Have I said you enough? Good, I'm doing the job. Yes, please.
Could you please give us another example of this 5% or
numerical or general?
anything?
Any? I combine it. Okay. Assume hypothetically that you are a manufacturer, right? You are an auto component manufacturer, and while you are an EV component manufacturer, an electrical vehicle manufacturer, and you have figured out a mechanism through which you can amp up the rate of charging of the batteries. You have patented it. Now, once you have patented it, you are using that patent to manufacture batteries for yourself so that you manufacture those batteries and sell them. Manufacturing is a qualifying act. Whether you sell these batteries to free zone clients, free zone customers or non-free zone customers, I don't care. Both ways you are eligible for 0% corporate tax rates. Yeah. But then you get a tweet. Oh, sorry, you get an X. Because that's what we call a tweet now, right? X. From who other but the owner himself, the great Mr. Elon Musk. And he says that, dude, I need that technology for my Tesla. You sell it because you know I'm fond of buying things and then burning them to ground. Sorry, you know the last moment to give worship. And you say that no, boss, I'm not going to sell that, I'm thinking, but if you want the tech, I can give you the tech, I'll charge royalty for every single battery that you manufacture, right? And you're excited about it because you're going to announce it on Twitter. Oh, you're going to announce it on X. That I have collaborated with the great Mr. Elon Musk. And now you start charging royalty, but that's where the problem is. Because remember, I told you that earning of royalty, what the money says. That's what happens when you create a success. I'm giving up. So that's what happens when you realize that one of the excluded activity is earning from immovable properties. Here, intellectual properties. Now this income by way of royalty from Tesla is assumed more than 5% of your total revenues. Your total revenues are assumed 100 million dirham. And you are earning a royalty of only 10 million dirham, which is small amount, right? Then that means the bulk of your income is qualifying income. You should be eligible, but you will not be because you have reached the de minimis 5% threshold. Let me change the example slightly. Assume hypothetically that your top line is not 100 million dirham, but it is 50 million. And when your top line is 50 million dirham, you are earning again this royalty of only 4 million. 4 million out of 60 million is anyway crossing the 5% limit, and it's also not crossing the 5 million dirham. And yet, because you crossed the 4% limit, you still have violated the de minimis clause, and your entire income, even from your manufacturing activity, will get hit by the de minimis clause. Either whichever is lower, whichever is lower, which means bottom line never beyond 5, right? Never beyond 5. There is, however, some scope for some legitimate planning. I'll give an example. Suppose there are certain incomes that you are earning from a permanent establishment that you have. What is permanent establishment? I'll answer that question. But for the sake of this discussion, let's assume you have a branch. You are a free zone company, and you have a branch in mainland. This is the reverse scenario, right? At the beginning, we talked about a mainland company having a branch in free zone. I am talking about opposite. You are a free zone company having a branch in free zone. Again, that is all. So you have a branch in mainland. Then all the income of that branch, which you say that yes, it's a branch, I am calculating this income belongs to my branch. Even if that income is more than 5%, even if that income is 50%, even if the entire 50% is non-qualified. Because you have come forward, you have declared to the FPJ that I have a branch in the mainland, and that branch is earning so much of income, which is more than de minimis, yet that will be excluded when calculating this de minimis threshold. That means, although you cross the 5% threshold, yet because you cross the 5% threshold because of the income which is attributable to the mainland branch, you will still continue to enjoy 0% corporate tax for that income which is attributable to your free zone operations, not to your mainland branch operations. This has allowed us a very legitimate opportunity to first fix the way we do business, and second, enjoy 0% corporate tax rate status, even if your non-qualifying income exceeds the de minimis threshold of 5% or 5 million. If you're interested in this thing, we can talk about it later. I just told you about permanent establishment, right? And I told you to assume that permanent establishment is a branch. But basically, permanent establishment is any fixed place through which you are carrying on business in another jurisdiction. By jurisdiction, I mean even a country outside of the UAE, or for that matter, mainland. Sometimes you don't have a fixed place through which you are carrying on business, but you have an identified person who's your agent. That agent is your dependent agent, that means he's dependent upon you. He's exclusive to you. He's not a general commission agent, he's exclusive to you. It could be a group company which is behaving as your agent, and that agent is selling on your behalf. Then, even that agent can be treated as a permanent establishment. Right? Even if that agent is a traveling salesman, traveling all throughout the GCC region or traveling all throughout Saudi Arabia, BSA, then even that agent can be treated as a permanent establishment. So therefore, all the income which can be attributed to that agent, even if that income is non-qualifying income, no one's come out clean, tell the FTA that I have a permanent establishment outside of the free zone. I'll pay tax on that income, and yet that would mean that rest of your income will remain ring fenced and will enjoy the 0% corporate tax rate schemes. We have already talked about all the other conditions, so I'm not repeating them here, but again, I repeat the warning. If you miss any of these conditions, any one of these conditions, for even one single year, you lose the advantage of 0% rate status for 5 years. Okay, what I'm planning to do now for next 5 to 7 minutes is that we will talk about, we will discuss a case study, because that will help us understand that how each of these activities have their own special sets of conditions. The reason why I've chosen distribution function is because I feel, and correct me if I'm wrong, that in the for DSO utilitarian DSO clients, a large part of them are carrying out activities which are more to the tune of distribution. Right? So if I'm, for instance, if I'm in job site, usually talk about manufacturing, so and so. So when we talk about distribution as a qualifying activity, I want to remind you, if you are carrying out distribution function for your clients which are also free zone persons, then I'm not going to be bothered about the conditions which I'll discuss now. When you are doing distribution activity for your clients and customers that are not free zone persons, then there are some additional conditions which we'll discuss now. What are those additional conditions? First, that the entire activity of distribution should be controlled from, should be carried out in the free zone. I'm not saying that the goods should be distributed in the free zone. No, I'm not saying that. I'm saying that the activity of distribution, your business, should be carried out in the free zone. And not just any free zone. It should be a designated zone, and to that extent, DSO for the time being does not qualify. Right? Job site is a designated zone, DMCC is not. Right? So a distribution activity carried out by non-free zone clients will not enjoy 0% CT rate if you are doing it from DSO, because for the time being, DSO is not a designated zone. Thirdly, if you are buying and selling, distribution is basically buying and selling. Right? If you are buying, then the goods should enter. If they are entering UAE, if they are not entering, because remember we discussed about build to ship to model, third port ship to. There, the goods do not enter UAE, then it is cool. But if they enter UAE, then they should enter UAE from outside of the UAE. That means you can import and sell, but you cannot buy locally and sell. Because when you buy locally, then goods do not enter UAE through a designated zone from outside UAE. No. Because they are already present in UAE. Right? When they are manufactured in UAE, they are already present in UAE. Then this condition is not met. A distribution function will be a qualifying activity in respect of sales made to non-free zone persons if you are distributing those goods which are imported from outside of UAE. They should be imported directly into that designated zone. And last condition, most striking condition to me, is condition that does not apply to you. It's a condition that applies to your customer. That your customer should be a reseller. Now you may ask me that, Gaurav, come on, what is this last condition supposed to do? If I'm selling my products to somebody who is going to consume them, suppose in its own manufacturing process, or suppose I'm selling machineries. I'm selling machineries to somebody who uses these machineries to manufacture more products and sell them. But he is not reselling these machineries. Come on, where is my fault? Because I am doing everything that you told me so far. Am I located in designated zone? Fine, I shifted to a designated zone. Instead of buying locally, have I started importing? Yes, I have started importing. Do I have substance now? Hell yes, I have substance now. Am I maintaining separate books of accounts? Yes. Audit? Yeah. And yet, now the last condition you have imposed upon me is one which I can't control. Or for that matter, how will you expect me to check whether or not my buyer is reselling these goods or consuming? How do I know? Am I supposed to go and audit? Because you guys are the auditors. You guys are the auditors. And the answer to that, luckily, to some extent, is given in the VAT designated zone guide, which says, relax, cool down, take a representation from your buyer. If your buyer takes a representation that it is not going to consume these products but is going to resell them, then all is good. After that, if the representation is false, it's the buyer's fault. But if you know for a fact that your buyer is actually going to consume the products, if your buyer therefore refuses to give you a false representation, then for absolutely no fault of yours, but just because you have this business model, you will not enjoy the 0% corporate tax rate. So I was giving you an example here that what I told you just now about different kinds of qualifying activity, just not the end of it. Every qualifying activity can have more sets of conditions applicable to it. These conditions will apply to some specific kinds of transactions and may not necessarily apply to other kinds of transactions. So what I explained to you just now was, so long as you are selling from a designated zone by importing from outside the UAE, if you are buyer is a reseller, you're good, you enjoy the 0% CVD. But if your buyer is consuming those goods, then you don't enjoy the 0% corporate tax rate, in spite of the fact that your business is no different in these two scenarios, right? You've already discussed this, so I'm not repeating it. By the way, there's just one word I want to familiarize. Designated zone. Sometimes, I'm going at a breakneck speed, I forget to explain to the uninitiated what I mean by designated zones. This is a concept which is given in VAT. Some zones are called gated zones. Right? Gated zones are same as designated zones. Right? So basically, these are the zones which have an outer periphery, where the movement of goods inside of that free zone and outside of the free zone is controlled, and the other zones which are ungated, they don't control this movement for the time being. Case of this and ungated zone. We have talked about how will you rely on the reseller, and the answer is a written statement from the reseller. We have talked about this. Yeah, that's pretty much it. This is a very unique issue which gets asked from us very often. That Gaurav, are you saying that the present CT law, at least, it encourages imports but does not encourage local manufacturing? Come to think of it. Technically, if you are buying from mainland and distributing those goods, then you do not meet the condition that goods should be imported in the UAE from outside the UAE. And therefore, you do not get qualified for the 0% rate. Therefore, technically speaking, in your business, if you decide today that so far I was buying from within UAE, but that's costing me 9% corporate tax. So therefore, if I stop buying locally and instead start importing, what will be my incremental cost? And if that incremental cost is still less than the tax on your entire business, you may actually decide to shift from purchasing locally manufactured goods to instead purchasing imported goods, which is odd, but presently at least the law is worded that way. So this is a question which gets asked from us. It's a frequently asked question, so I just decided I'll address it anyway. Another very important kind of business that I want to talk about here in DSO is services business, because a lot of DSO clients are in services, right? So for services business, I have already explained to you what's the contours. Let's see which of these are covered. Marketing support services. If you are rendering marketing support services as a part of headquarter function, if you are providing these services as a part of headquarter function, that means you are giving marketing support services to your own group companies, but not just marketing support services. Because rendering only marketing support services does not make you a headquarter. It makes you a sales agent analyst. Right? If you are acting as a headquarter and in the course of it, one service is marketing support, good for you. You are eligible for 0% rate. But if you are rendering marketing support services to third-party customers, not your group companies, or if you are rendering marketing support services to group companies but on a standalone basis, not acting as a headquarter, then this activity is not eligible for 0% corporate tax rate status. Same way about managerial services, back office services. I want to specifically talk about back office services because this is also a service a lot of people aspire to carry out. And this will also have the same answer that we talk about marketing support services, unless we are talking about certain specific kinds of services such as treasury and finance support functions for group companies, because we discussed how treasury and finance support services specifically to group companies is listed in is given in the list of qualifying activities. So all of these services, professional services, shipbroking, because in shipbroker you don't operate a ship. E-commerce, digital media businesses, intermediaries, digital assets, cryptos, NFTs, all of these do not qualify for 0% corporate tax rate status. We are nearing towards the end of this discussion, but we have a question, sir, please.
What about consulting services if you offer inside the free zone to free zone company?
Oh, yeah. So all of these examples, sir, that I have just now discussed, right? And the one before that, the one that oh my God, yes, yeah, distribution, right? All of this is in the context where your customer is not a free zone person. If your customer is a free zone person, then everything is covered except excluded services. That means, if suppose you are providing consultancy services within the free zone to another free zone entity, but it is covered in the list of excluded activity, then it's an issue, otherwise 0%. Right?
I have a very quick question.
Quick question.
It's a mainland company that is operating as a free zone, let's say DSO.
Yeah.
So it's like it's registered by mainland, right?
Right.
And it's providing services, it's got its office in the free zone like DSO. So it's going to provide services to another free zone company.
Right.
So would that qualify as 0% or?
So if the mainland company, which has an office out here,
right,
and that office is registered as a branch office of the mainland company, that is an important condition.
okay.
If it is registered as a branch office of the mainland company, then that branch office will suddenly acquire the identity of a separate free zone person and will not become eligible.
Okay, but if the mainland itself is
Then-
registered in the free zone.
Then I'm free.
Yeah.
I'll come to the questions, right? Give me just 2 minutes, because these are just last 2 slides which are left, right? After that, I have some solutions for you, and then I will move to the questions. This last slide is very important because there's a reason why this is important. Because if you see our videos, right, which maybe they're in public domain somewhere, then you might find that those things that we said in June of 2022 are starkly different from what we are saying today. Right? That's not because I'm dumb. I mean, I am dumb, but that's not because I'm dumb. Right? That is because, as I mentioned at the beginning, the law has pivoted significantly. In April, the public consultation document, which was a bare minimum 10-12 page document, which contained only 1.5 page for free zones, said a few things which are starkly different from the detailed free zone related regulations contained in the cabinet decision and ministerial decision. Therefore, we are in a day and age when everybody loves to Google, right? We Google our symptoms. Whenever I have even the slightest of fever, I Google and I realize I'm going to die in 2 days. That's what everybody tells me. I'm going to die in 2 days, right? My wife also says this all this time. I think she is wishing it, but I don't. So what I'm trying to highlight here is, you might find some contradictory statements. I want to tell you about them in advance so that you don't get confused about it if you are as much of an obsessive Googler as I am. For example, PCD said that we honor the incentives which were given to free zones, and therefore free zones will always, will enjoy this 0% corporate tax rate waivers, right? Awesome. What the law now says is some very limited set of activities, which are qualified activities, will enjoy the 0% corporate tax rate status. Similarly, all the transactions with those clients which are located outside of the UAE, right? Initially, the PCD appeared to suggest, suggested that transactions with free zone persons and transactions with foreign persons will be at par. But that's not true. On the contrary, transactions with mainland person and transactions with foreign persons are now at par. Usually, most of the economies worldwide, they try to incentivize export of goods and services, right? That is not necessarily the case here, right? So just because you are exporting goods and services does not mean you enjoy 0% corporate tax rate. That is true if and only if you are carrying out those particular activities which we saw on the slide as qualifying activities. Other than that, export of goods and services, just because it is export, does not automatically get qualified. Third condition, you are required to comply with all the regulatory requirements. What do I mean by all? I mean even those regulations which are not tax regulations. Now this was a condition which was appearing in the PCD. Interestingly, it is missing from the corporate tax law. But I'm not sort of suggesting that you start flouting all the rest of the regulations because now it's not relevant. I'm not suggesting that. What I'm saying is, earlier it appeared that if you're non-compliant, then you suddenly lose the advantage. Now that is not at least written in that. Very interestingly, the PCD said something which is curious. It said that if there is a group company located in mainland, group company of a free zone entity, then if the free zone entity is earning an income from its own group company, then the income will enjoy 0% rate, but the expense of the group company in mainland will not be taxed at that way. Which is interesting, right? Because otherwise you might get tempted into thinking that let's do one thing. I'll book a lot of expenses in my mainland account and shift all those profits to free zone and not pay any tax on free zone because I'll carry out those activities which are qualified. So I have almost discovered perpetual motion. Curiously, this is missing actually in the corporate tax law. Does that mean that you can do all of that now? Actually no. Because remember I told you, in order to qualify as a free zone person, you have to meet the transfer pricing test. Which means that you can book expenses in the mainland entity if and only if those expenses are genuinely at an arm's length in relation to those goods and services which are sold to the free zone company. If they are not, which are bought from the free zone company, they are not. If they are only fictitious transactions, they will not ever meet the arm's length test. Earlier, the PCD suggested that if you make any mistake, then you get a huge lash and you lose entire 0% rate benefit. Now the law is more benevolent and it gives you this 5% de minimis safe harbor. So this is another difference that you see between the PCD and the corporate tax. Now, I take a pause. This is the last set of slides. These are not any learning slides. This is just something that at Moon we thought that we have been having these discussions at DSO for so long. How do we contribute more to DSO clients, DSO clients? And if any of you, so far we have had this discussion. If you want to discuss more, by the way, right? You just keep feeding us coffee, right? And we keep working. So that's a machine. But after a point of time, if you want to have a conversation about your specific business, if you want to understand that, look, I'm doing this business, I want to understand how corporate tax law is going to apply to me. These are my facts. These are the nature of my clients. These are the nature of my products and offerings. These are my related party transactions. Whether I borrow from my related parties or take capital from my related parties and so on and so forth. Then, what we can do for you is we can set up an hour-long session with an expert, a subject matter expert, and that person can understand your facts in more detail. That person can ask you counter questions. In fact, even before the call will begin, you will receive a couple of days beforehand a standard list of questions that you should expect us to ask. So you don't have to fill up like a questionnaire and send it back to us because I know how painful it is to fill up questions. I hate it too. So therefore, don't do that. This is just for your information what questions we will ask. And then based upon that question, we just be prepared with the answers in your mind, and in the call, we can discuss about those questions. And based upon it, in the call, we'll give you our views that how will corporate tax law affect your business. We can tell you what are your compliance obligations. We can tell you what are the kinds of mistakes you are probably making right now, which will cost you your 0% corporate tax rate status and how to try and avoid them. And of course, if it is getting too complex, then we will take this forward in a more professional manner, but otherwise, we will welcome you to ask your questions from us. Our entire contact details are at the end of the slide, and you can reach out to us anytime on those contact details. I throw the floor open for question and answers. Gentlemen at the back. Yes.
So I have a generic question.
Generic.
So the first thing for us to understand if we are liable for this corporate tax, we look at the income, right? So if our income crossed the threshold of 375,000, then we look into the qualifying aspects of it. Is that correct?
No, it's not correct. 375,000 dirhams is a limit which is relevant and applicable only to mainland businesses.
Okay.
If you're a free zone business, then that limit has zero relevance for you.
So that's zero relevant. So the first thing that we should look at to know if we are liable for this tax is what?
Yes.
What is the first thing that we should look at?
You should look at what kind of clients and customers do you have. Are they free zone or are they non-free zone?
Okay.
And then if they are non-free zone, I'm just making a guess. If they are non-free zone, regular people, like individuals,
Yes.
then actually I'm giving you the answer.
Sorry?
Then I'm giving you the answer.
Okay.
You don't qualify.
Oh.
No, let just add one sentence here. What exactly is your business? Because unless you are actually an investment advisor, then I'm wrong.
So let's say it's e-commerce, for example.
E-commerce?
Yes.
Okay, what do you say?
Personal care line.
Personal care items. Hair care products?
Yes.
Yeah? You're messing with me? Okay, no. But yes, okay, the answer to your question is you are selling to individuals, right?
Anybody, yeah. Anybody just
Mostly individuals, right? Hair care products generally tend to be used not by corporates,
Right.
because the corporates are the ones who cause this. But if you are selling generally to individuals, sir, then you are carrying out activities which are called excluded activities. Then, as a result, you will not qualify for 6% corporate tax credits. You owe your corporate tax. I'll give you that.
You will not qualify.
You will not.
So you basically we have to.
Pay tax with a heavy heart. You sound that are you kidding me? Are you giving me the answer here? That's so bad.
What tax is he paid? Is he paid on the total revenue received? The gross?
On your net profit, sir. On your net profit. You pay tax on your book profit as adjusted by several adjustments. Now that is probably a topic we can discuss another day. Another question, sir? Yes.
Is there a distinction between onshore and offshore free zone?
Not really. The distinction is actually between designated and non-designated. But onshore, offshore, that distinction does not exist in this law, in the corporate tax. So I hear what you're saying. For instance, you have a jobs onshore, jobs offshore company. There's no distinction between the two. Because unlike some laws which talk about licensees, right, that offshore companies sometimes don't have licenses, right? This law does not care about licensing per se.